All right, we are live, and today is January. What is today? January 30th, I think. Oops. Today's January 30th. No. Today is January 30th, 2019. So we are live. Looking forward to you all joining us. We went a little bit later tonight to give our friends on the West Coast time to settle in from a hard day in the office for sure. Very much looking forward to for them joining as well. Of course, all of our good friends on the East Coast here. Thanks for staying up late. Corey, present accounted for. Good deal. Corey, my friend Corey Grimm, has got a YouTube channel called The Grimm Perspective. And by all means, check it out. You can click on the, well, I guess you can't click on that link. But if you're interested in actually, Corey, what if you don't mind, just post a little bit about what your YouTube channel is. That way people can know what you're doing. That'd be great. And actually, if you don't mind, folks, if you can give me a thumbs up that you can hear me. I got this mic here. It looks like it's plugged in. Scott, what's going on, my man? Thumbs up if you can hear, if the audio is okay. Oh, that's some hot tea. Eesh, my goodness. Ouch, just burned my tongue. All right, cool. Gotcha. Man, all right, right on. All right, cool. Thank you, Big Willie. Big Willie, right on. Where you guys, Big Willie, where are you from? What state are you in? Scott, you're in Georgia, if I'm not mistaken. And Corey, I think you are in Michigan or something like that. I forgot where you are. So what I'm going to do is just probably minimize this guy right there. All right, sweet. Thanks, Greg. Right on. Got your email. I will respond back to that tomorrow, my friend. I did get your email. Grand Rapids, Michigan. Right on, right on. Balmy day. I do have an opinion about Ed Jones. I will start the questions with that. So, yes, sir. Absolutely. In fact, I wonder if I can cut and paste that right there. If I can put that down here. All right. Oops. Restore chat. What happened? Okay, there we go. All right, cool. Hold on just a second, folks, and we will get started. All right. All right. Cool. We got a couple good questions already. That's fantastic. I'll wait till 8:30. A balmy day here in Georgia. They called they called school yesterday, but they called it at 11 a.m. the Monday before. So they called school polar vortex the day before at 11, and then we didn't get any snow or anything. All right, so it's 8:30. I can go ahead and get here started. So I appreciate y'all being here. Thanks again for coming on board a little bit late tonight. Hello, Marie Landis. And if you don't mind, I'm always curious of where people are watching from. So, if you want to put some notes in there, say, hey, you're from here, from there, it doesn't matter. Just my own intrigue, actually. I'm always intrigued by this. And again, if the thing goes out, like I haven't got my computer on already. I'm still waiting to get my stupid MacBook. I get caught up in this YouTube stuff, and I do Tallahassee, Tennessee. Right on, Chris. I get caught up in the YouTube stuff, and I always forget to order something, and so I don't have it on Ethernet right now. Still on my Wi-Fi. Pennsylvania, right on. PA, all right. PA in the house. Krakow, Krakow. CB from Michigan, yes sir. The Black Cow, KOW, the original manure, the mature manure. Black Cow, the mature manure, Black Cow. Howard, the dirtdoctor.com, Howard Garrett in Tennessee, and not Tennessee, Dallas, Texas, has a podcast where he talks about organic landscape and whatnot. And the Black Cow always advertises the mature manure on the Howard Garrett podcast, the Black Cow, or the Dirt Doctor. All right. So we got North Carolina, Union, New Jersey, Clearwater, Kansas. Right on. We got Oklahoma in the house as well. Springfield, Illinois. Right on. I had a friend of mine when I was in the Army from Springfield, Illinois. Don't know if he is still up there. And, of course, I got out in 1992, so that was a long time ago. but I remember him telling me Springfield, Illinois, Illinois is the land of corn. I said, you're crazy. And one time I drove through Southern Illinois, and he was right. It is the land of corn. All right, so what do I have to think about Ed Jones? I actually have no problem with Ed Jones. I mean, I think I did a video today, and I'm just drinking some hot tea here, so if you wonder what I'm looking down here, I did a video today on how an Ed Jones guy it was snaked this guy when it came to commissions. Actually, it still ticks me off. And this doesn't act like my man Roy Jones, not the boxer Roy Jones, but Roy Jones, an old financial advisor, and I don't know him to be old as age, but at least a grizzly old veteran of financial advisor posted on the YouTube channel. He goes, basically those days are kind of behind us, where people are basically, what happens is you have A-share mutual funds and you can pay 5.5 commission up to $50,000. But once you go above $50,000, the commission goes down to 5%. Once you go to above 100,000, the commission goes down like 3.5%, and so on and so on. Anyway, long story short, if you have 99,000 in American funds, you're paying 5%. If you have 99,000 in Oppenheimer, you're paying 5% on Oppenheimer and 5% on American funds. Whereas if you had 198,000 in American funds, you'd be paying 3.5%. And so essentially, you're paying what's that? 5 times $10,000 roughly in commissions by splitting up the mutual funds companies, a part in American funds, a part in the Oppenheimer. Where if you just went solely with American funds, you'd only pay $6,000, if that makes sense. And in the industry, in Ed Jones, they did it too. I mean, but lots of people in the industry, it wasn't just Ed Jones, it's Smith Barney, Merrill Lynch, all these guys, the commission-based financial advisors were doing this. They weren't taking advantage of the break points. And so if you're buying a commission-based front-end sales commission, and you can, I'm just telling you right now, what happens is you have a certain amount of money into that one fund company will give you less and less of commissions as you go forward in buying that one company's investments. And so if you're splitting up between Ed Jones, you're going to Ed Jones, you're splitting up between American funds and Oppenheimer and other companies, that's just the wrong answer, because American funds has everything you need. And so now I was telling a guy the other day from Texas, matter of fact, from not Dallas, but around that way, North Texas, and he has $1 million in his 401k, and he wants a local presence. I said, just go to. He's working with a guy at Ed Jones, and the Ed Jones guys calls him on occasion to sell him some stocks and stuff. I said, look, I got no problem with that at all, none. I would have a problem if the guy was splitting you up, say 249 in American funds, 249 in Franklin, 249 in Oppenheimer. I mean, that's just, you can't be doing that stuff. But anyway, the issue was once you break $1 million. You don't have any commissions. It's completely at NAV. That's net asset value. That means you're buying into American funds 100% with no commissions. And I'm a huge fan of American funds. Gigantic. Their fees are absolutely low. You're talking 45 basis points for the A shares. I mean, you can't beat that. You can't. Now, I think if it's I don't know if I think that the advisor gets paid 25 basis points. That's 1/4%. So for $1 million, you're going to get it's going to cost you $2,500 a year to have that advisor manage your accounts. And I just think it's money well spent. So I'm a big fan of American funds, and Ed Jones is the biggest purveyor of American funds. Edward Jones is. And I also like Ed Jones too, because they do old-fashioned brokerage. Now, they're not financial advisors in terms of financial planning. I know everyone's trying to call themselves that, but they shouldn't, because they're brokers. And I actually have no problem with that. They sell you stocks, they sell you bonds, they sell you mutual funds. They even have brokered CDs and stuff. And as long as you know what you're paying for, I got no problem with it. Where I don't like the industry is going, let me just take a sip here. Oh man, that tea is still pretty hot. Where I don't like the industry is going, and this is Ed Jones and all the other guys, USAA, hell, even Vanguard is doing this, is this managed money. I'd much rather have you pay a front end, who asked Joe, I'd much rather have it pay a front end commission and never pay another commission. I'm just telling you right now, the idea that you're going to underperform by paying a commission, some guy who's paying a 1% annual management fee, what's called assets under management, AUM. It's silly. I mean, it's easy to disprove that in 2 seconds flat. I've done video on that before, and I'll do it again. I'd much rather you have pay 3.5% up front and only pay 25 basis points over the course of the remaining time you're with that advisor, as opposed to 1% each and every year. There's no justification for 1% fee. I'm just sorry. There's just not. And there is a justification if you have to pay somebody for paying a front end commission and just a little bit of a trail just to keep the guy to manage your account. Now, what in my guy's case, I said, look, the guy will call you with some CDs, he'll call you with some bonds, he'll call you with some stocks, and if you want to, tinker with some of that, that's fine. Absolutely no problem with that at all. I'm working with a guy up in Chattanooga, and his hedge fund guy calls him a lot to say, hey, we're doing these laddered CDs. I can get you 3.2%. It's a brokered CD from Bank of Oklahoma or something like that. And so I'm a fan of Ed Jones, as long as they don't try to force people who had already paid A shares into managed accounts. I don't like that at all. And that's my concern with a lot of these firms. Fidelity, I don't think Vanguard would do this. And I'll talk about this till I'm blue in the face. But these guys are using Fidelity, Schwab as a loss leader. They're index funds that have no basis, that don't charge anything. And then what they're going to do is they're going to pick up the horn. They're going to say, hey, Joe, this is old Bob down at Charles Schwab. I know you got this S&P 500 index fund, but have you ever thought about doing this instead? And that's actually a good sales tactic. It is, because the fact that you have an account with them allows them the opportunity to call you. You can't be on the do not call list in that regard. And so they can have the option to call you and to solicit your business for other things. And it's a loss leader. There's no other way around that. They're hoping that they can generate enough volume by getting people to buy their low cost, if any cost, index funds or whatever, that they can solicit them in the future. I mean, that's exactly what's going on, and hopefully turn that people into managed money. I was just talking with a lady, when was this? Saturday, maybe. And that's exactly what happened to her. Off the top of my head, I can't remember the specifics, but she had money in a non-fee account, and then they called her, and they just hit her at the right time. She goes, I don't know if I am able to manage my own account, so I will turn it over to a fee-based account. And then she never heard from these guys again. It's nuts. So anyway, I hope that answers your question. Ed Jones, no problem at all. Dave Valenzuela. Let's see here. What percentage of my Social Security if I would collect at 62? David, it depends on your full retirement age. I'm going to assume it's 66. So remember, folks, your full retirement age is if you're born in 1960 or beyond. Like I was born in 1970. My full retirement age is 67 years old. All right. So I know for a fact I will get my full PIA, my primary insurance amount, my PIA. I'll get 100% of that when I'm 67. I will get 108% of that when I'm 68, 116% when I'm 69, and 124% when I'm 70. If I'm take my Social Security earlier, I want to say it's 7.25, 7.5 reduction. So 75%, if I'm not mistaken, is it 70%? I think it's 70% now. So when I'm at 62, if my FRA, my full retirement age is 67, when I'm 62, my benefit will be 70%. So if of my PIA. So to make this even more complex, if my primary insurance amount is $1,000, that's the amount I get at my full retirement age at 67. That's the number one thing you got to know. What is your full retirement age, and what's your PIA, your primary insurance amount? So for me, old Josh, if my primary insurance amount is $1,000, again, that's the amount I get when I'm 67. It'll be $700 a month when I'm 62 because I've taken it early. On the contrary, it'll be $1,240 when I'm 70. So I have a range there of 700, 1,000, and 1,240. If that makes sense. Now, I just got to be very, very clear here. A lot of people think their spousal benefit will be based on the amount I take at my 70, which is what's called delayed earnings credits. It isn't. So my spousal benefit, my spouse, my wife, Charlotte, will get her spousal benefit off of my record at my PIA, regardless of when I take it. So let's just use for simplicity, I take my benefit at 70. And again, my PIA was $1,000 a month, but I waited till I was 70. So now I'm getting $1,240. My wife takes her spousal benefit, which will be half of mine. It's still going to be a half of that $1,000 because she does not get spousal benefits on the delayed earnings credits. She does not. She only gets spousal benefits up to my full retirement age amount, which is 67 years old. Hope that makes sense. Now, if I take mine early, it still doesn't affect her spousal benefit because her spousal benefit is based on if she takes hers early, if you can believe that. It's nuts, but it is the way it works. So you got to understand there's also leaving money on the table. But just as a thought process, the spousal benefit is contingent on when the spouse takes the benefit. It is not contingent on when the primary breadwinner takes the benefit. It's only contingent on her taking the benefit or him at his or her full retirement age or earlier. Absolutely, under no circumstance, if someone's going to get a spousal benefit, should they delay taking that till they're 70. They get no further benefit. None. So if you're going to get a spousal benefit, again, half of the other earner's benefit at your full retirement age, if you're going to get a spousal benefit of $1,000, we'll just say that for example, and your own benefit based on your own record is $800, just using this for example, all right? And you say, well, I'm going to wait until I'm 70 because my spousal benefit will grow at the 8% delayed earnings credits. No, it won't. That's a foolish mistake. And people do this all the time, or else they plan for it. It's dumb. Don't do that because your spousal benefit is $1,000. It will not be $1,000 plus 8%, then $1,000 plus 16%. It's not going to be. The spousal benefit is half of the main breadwinner's primary insurance amount. That's it. There's no more than that. So if you're relying on a spousal benefit, heaven forbid you don't take that at your full retirement age or earlier. It's just you're wasting money if you don't. Hope that helps. Social Security, a lot going on there. Wisconsin, Springfield. Yep. Does PIA have a? That's what they're. This question. Okay. Wait, I skipped over. Hold on, just a sec. Skipped over a couple things here. Sorry. Wow, I skipped over a lot. Okay, hold on. Okay, Union, New Jersey. All right, David Valenzuela, Union, New Jersey. No relation to Fernando Valenzuela. Remember Fernando played for the Dodgers, the rookie year when the Dodgers, I think is that when they beat the Yankees? They lost the Yankees in 77 and 78, and then I think in 81 they beat them. Like your shorter videos, 15 minutes or less. Yeah, 10 to 15 minutes is a sweet spot. I try to, I'm trying to divide them up so I can go about 10 to 15 minutes. Understood. Sometimes I just yap. I get it, whatever. Sometimes put on half or 2 times speed, I suppose. But I do try to chop them up a little bit, Mary, like I did today on my thing with the fixed index annuities. I'm going to chop those up into 3. All right. Try and decide if and how to convert from IRA to Roth. 57 have 60,000 to convert. Roth IRA 57 and have 60,000 to convert. Yeah, I don't. There's too much. There's not enough information for me to know that. You'd have to elaborate some on that. Ed Jones or not? I don't know, man. CB, I'm not. If that's, I don't know. Ed Jones are not your friends. I know a bunch of guys over there, and they're pretty honest for the most part. They make money. Don't get me wrong. They make money by you investing with them. And I frankly don't care about that as long as they disclose that. Municipal bonds, where they fit in a financial portfolio, says my man John. I'm just not a fan of bonds, generally speaking, which goes against when I talk about how much I love the Wellington Fund and the Wellesley Fund. But if you got municipal bonds, and here's what happens. Oh, for the love of me. All right, so we got municipal bonds, all right, and then we have stocks in an IRA. So we have municipal bonds outside an IRA, and we'll have stocks inside an IRA. And I literally want to take an anvil. Remember, like those old anvils from Speedy Gonzalez, whatever the cartoon that was, and drop it on my head because I just want to kill myself. Municipal bonds in and outside an IRA, that should be exact opposite. You should have corporate bonds or government bonds in your IRA, and then you should have stocks that yield dividends, qualified dividends, long-term capital gains, if anything, outside your IRA instead. And the reason for this is because what you're doing now is you're taking the stocks that should be taxed at long-term capital gains, which is 0 or 15%, depending on your tax bracket. It could be higher if you're making big scratch. But anyway, 0 to 15, you're switching them into ordinary income from an IRA, because anything that comes from an ordinary income from an IRA is taxed on the very first dollar is ordinary income. Now, don't do that. And then on top of that, it's even worse. You're taking a bond, which could get 3.5%, taxed as ordinary income, and turn around, you're going to get 2.5% on a tax-exempt municipal bond. So it's the exact opposite of what should happen. It's nuts, and everybody does this. And on top of that, municipal bond interest, tax exempt, even though it is added to your taxes when it comes to your Social Security benefit and your provisional income. I mean, your provisional income for Social Security benefit, and on how much of a premium you're going to pay on your Medicare. It just, and so I don't get this, why we have municipal bonds over here and then we have stocks in the IRA. It's the exact opposite that should happen. And it drives me up the wall. It's one of my most frustrating things ever. Now, my man Alberto bought some municipal bonds at 5%. I think he said he bought them in 19 or 2005. I can't remember. I mean, if you can get a 5% tax in a bond, municipal bond, I'm not good. I mean, that's a smoking deal. You're not getting those today. You're not going to the market and buying a 5% municipal bond and a highly rated. It's not happening. And so because of that, those days are well beyond us. It's not happening. At least a highly rated credit municipal bond. You might be able to go to a Jefferson County in Alabama and buy a 5% municipal bond. But the reason you're buying that puppy is because they went bankrupt 10 years ago. All right. So Stockton, California, the same thing. So why would you want to touch that? I just don't like it. I don't think municipal bonds serve a purpose in anyone's portfolio if they have stocks in IRA. So my opinion, I think my opinion is quite valid in that regard. If you just think about what's called asset location. So you have your corporate bonds, which pay 3 and 4%, and you have your stocks in an IRA. That way, when it comes out, you're paying ordinary income. You have your stocks that give you unlimited growth. So that way, when you die, it transfers to your heirs completely tax-free anyway. The growth is not taxed when your heirs inherit that. So we know for a fact there's a benefit to them. And if anything, you're paying 0 to 15% on any long-term capital gain or qualified dividend out here. So basically what we're doing is we're getting higher yields inside our IRA and better after-tax return outside of our IRA with much better for estate planning. And if you live in a community property, California comes to mind. Most of out west, I don't think Louisiana falls as a different thing. I'm trying to think what the community property is the closest to the East Coast. I don't know off the top of my head, but California, Idaho, all those states out west for the most part, community property. When you die and you're married, your spouse inherits the entirety of the property as tax-free because of the community property statutes, which basically say the survivor gets the community property with a step-up basis on the entire amount. It's nuts. No one takes advantage of this, I'm telling you, and it's the best thing ever. So in that case, Charlotte, my wife, my beautiful, and me, and I got $100,000 of Apple stock. And I think Apple just boomed today. Man, Apple just looks good to me. I'm telling you right now. I looked at the other day. I said, man, I can't believe Apple is trading with a PE ratio as low as it was. I'm not saying buying it. The minute you buy, it's going to go bankrupt. I'm just saying, man, I was stunned. Anyway, so say you got 100 shares of Apple stock. It's trading at $100 or whatever. Now you die, it's worth $200. All right, so you doubled your money in Apple stock. You get hit by the mailman. My wife's Charlotte will inherit that whole 200 stock if I lived in a community property state completely tax-free because of the step up in basis. And a common law property like good old state of Georgia is not the same. She'll inherit half of that with a step up basis tax-free, but the other half is still her basis. I know that's a lot to chomp on. Trust me, I get it. A lot to chat about. None of that is applicable to municipal bonds. Why? Because municipal bonds and bonds don't grow. I cannot stress this enough. There is no growth in bonds. Bonds give you an income like a CD. No one ever sits there and says CDs grow. Why? Because we know how a CD works. You put $100,000 in, it's paying 3%. You're going to come back and collect your $100,000 and you get $3,000 a year of interest, which is taxable. The bonds are the exact same thing. Bonds are the exact same thing. There is no growth in bonds. So if I have a taxable account, i.e. I get one that's favorable treatment on dividends and capital gains, and it's favorable in treatment if I'm in a community property to my spouse. And if I'm even in a common law state to my spouse, not quite the same as community property, but still either way is much more favorable from a step-up basis if I die. And it's certainly more favorable to my heirs. The growth, I want my higher growth, lower taxable stuff in my non-taxable account. I want my more taxable stuff. That would be real estate investment trust. Yeah, I want those in my Roth, but still corporate and government bonds in my IRA because there is no growth in bonds. So because of that, there is no step-up basis, none whatsoever. On top of that, because corporate bonds and government bonds pay 100% income tax on the interest you gain as ordinary income, but municipal bonds, it is tax-free, but there's no growth you're not making much money. So long-winded answer. Understand where you're living, folks. Understand the community property versus the common law, and understand the methodology of a step-up basis. I'm telling you right now, if you can leave your spouse significant assets that have grown over the course of your lives together, and she inherits that without paying tax on it, that's a smoking deal. Conversely, she inherits it in an IRA, and not only she's paying tax on that because she's going to have required distributions, but those RMDs are also going to subject her Social Security more taxes, her Medicare premiums to higher premiums, and on top they'll take a 0% potentially tax asset and a long-term capital gain and qualified dividend to a taxable asset as well. Boom, it drives me insane. All right, so the anvil is off my head now. All right, what's your advice on paying down debt or increasing? I pay down debt. I'm 100%. So the question my man Brian Dobson asks, what's my advice on paying down debt or increasing 401k and IRA max funding? I pay down debt, and this is absolutely, I take my 401k to the extent that my company matches, then I'm paying down that debt like crazy. That is the one thing you can control in terms of maximizing your financial plan. Let me just take a quick thing of my Walmart peppermint tea there. It's pretty good. All right, so I pay down debt without question. But don't sacrifice the free money your 401k provides you, Brian. Definitely pay down debt. All right, so just why I'm yapping on that. The reason for that is because I've done so many financial plans, so many. And the one thing that is always constant, there's one thing that's always constant. The people who have no debt in retirement are just more successful. Not more successful financially, Mr. Burns, but more successful financially from a relaxation and the ability to not worry so much. I'm telling you, the problem with 401k and IRA and investments generally is you're relying on something that's completely out of your control, i.e. the markets. And the markets are bonds or stocks. And I'm telling you, the more you rely on things that are outside of your control, the less control you have and the more it stresses you out. There's no two other ways around that. And so when you have no debt, that is the one thing you can do to assure your financial ability to just hang in there, because you're like, I don't care if the market's down 8,000 points a day because I'm not in it, or at least I'm in it, but I don't need it to put food on my table. And I just tell you, man, I've seen it a million times a Sunday. People who are in retirement with no debt, they're just more comfortable. They actually have studies. One of these days I'll do a video on it. It's a research paper I read 4, maybe 6 years ago. They actually did studies on people, their happiness in retirement. And the bulk, by far and away, the happier people were ones that had no debt. Not because it's funny, two things. They had no debt and they had more liquidity, more cash. Isn't that interesting? It wasn't because they didn't have enough money, a big wealthy guy. They just had no debt and more cash on the side. They were happier because they didn't have as much worry. Now, again, in terms of economics would say, is that the best utility to maximize your returns? And no, it's not. This is where economics gets silly when they try to go this hard science of mathematics and equations. It's not that. It's psychological. You're saying at the end of the day, I am not maximize returns. And economists would say, well, that's dumb. You're not opportunity, taking advantage of the opportunity and whatnot. And that's not good utility. And I'm saying I could care less about your stupid utility. I can sleep at night. And I can sleep at night better with no debt and more cash on the side than you can with your maximized 401k. They have this efficient frontier and all that. It's just stupid. It's just, we have all these financial planners out there saying, we have this efficient frontier that says you should be here. No. What happened? This is what I always say to people. And I used to say it all the time when I was at USA. You get $100,000. A year from now, it's worth $60,000. How do you feel? You're down $40,000. That's the difference between you got $100,000 and next year you're down 40%. 40% isn't the same as $40,000, especially when you're in retirement. And that's one of the things about fee-based accounts, my friends. When people are saying, I'll charge you just 1%, you say, how much is that? You have them tell you how much that is in real dollars. I'm telling you, I was trained on the opposite side, my friends. Fee advisors will say 1%. And the minute they were questioned how much that 1% equated to actual dollars, they knew they lost. I'm telling you right now, I got books. Well, I don't know if y'all can see that, but books on the wall that trains you how to position manage money. The minute you turned 1% to actual dollar amount, the advisor knew he lost. And the reason for that is because people say, why under God's green earth should I pay you $17,000 a year to manage my money? And the advisor says, it's not $17,000, it's just 1% or whatever the hell it is. But yet that's what the advisors are trained. So what you've got to do is this is no longer to you, Brian, just you generally folks, is you got to tell your guy or gal who's trying to put you into manage money. So, okay, I get it's 1%. I got a $500,000 portfolio. How much is that? Well, it's 1% of 500,000. How much is that? 1% of 500,000. I need the dollar specifics. How much is that? And the more they hem and the haw, the less they are comfortable in managing that fee. So I was talking to a good advisor I'm very fond of up in Northern Virginia yesterday, as a matter of fact. Actually, he's literally my brother from another mother. It's nuts. He's born on the exact same day I was, and he charges a $5,000 flat fee. He says, I charge $5,000. And that's it. That's what he says, $5,000. And if you want to work with me, you're going to pay $5,000. No more, no less. That's what you're going to charge. And he had a couple guys say, I want to negotiate the fee. He goes, I don't do that. I am worth $5,000. And I love it. I said, that's the way to go right there. 100%. He manages the money too. All right. He goes, so I'm charging $5,000. We're doing everything all encompassing. And if you want me to be your advisor, I am worth $5,000. And he doesn't know this crazy 1% or 0.5. It's just straight up cash money. That way, when people hire him, they know exactly what the cost is going to be. I love that. I wish more advisors would do that. And up in Northern Virginia, $5,000 is a lot different than in Anniston, Alabama. But still, at the end of the day, at least people know what they're getting for. So I'm a big, big fan of that. I'm just telling you, the industry has manipulated tools now on ways you don't see how much that 1% actually equals in terms of cash you pay. I'm just telling you. So you always got to turn around. How much is that, Mr. and Mrs. Jones, that you're going to charge me for my $500,000 portfolio? And if they hem and haw. All right, lastly on this, because I get fired up on this stuff. I was working with a wonderful couple out in California. There are good people in California. I'll never step in that state anymore. But I'll tell you, there are good people out there, tons of them, which is why I did my video on leaving California the other day. They went to Schwab. This is a Schwab now, and these are wonderful people. And they said, hey, Schwab guy, how much am I charging? The guy's like, hem and haw. I said, see, these guys don't have any, it's like water going downhill. Water going downhill or just electricity current. It takes the path of least resistance. So if you allow your guy to get away with this 1%, all right, well, how much is the total? What's my total cost? It's 1%. How much is that? No, don't do that. You say, I want to know the fees, the actual dollar amount I'm paying. And now what's going to happen is they're going to say, this guy's had a hem and haw. He goes, well, I got to get back to you. I'm like, hell, what's that? You got to get back to me? I guarantee you know exactly what your commission run is, your fee run is. I guarantee you know that. On top of that, what do you got to get back to me on? What could there possibly be that you need to get back to me on, Mr. Charles Schwab guy? This is Schwab. And the thing is, there is nothing to get back. He knows what he's getting. He gets his daily report on his fees. I know how this stuff works. His fees say, Mrs. Smith in La Jolla, California, I'm getting paid $1,500, whatever it is. I don't know what it is. They know exactly what they're getting. And on top of that, they know the funds that they have you invested in as well. So in this case, she had a couple mutual funds, a couple ETFs and whatnot. I said, just ask what the all-in fee is. And he gave him percent. I said, no, percentage points aren't what we're shooting for. We are shooting for the dollar amount. All right. So let me drop that. Cash is king. Pay down debt. I completely agree. My man, Jeff, pay off all debt by house once all other debt is gone up. 401k, Roth versus Spousal. I don't know if I agree with that so much. I still like paying down your house too. Okay, it is a debt, but I'll leave that for other people to decide. Good plan, Brian. Joe K. Thanks. If I have, I keep doing that. Hold on. Growth Fund of America. I see that. I'm a big fan. Okay. What happened? Okay. I just went way too far down. All right. So there's Jeff. Wait, Jeff, man. Come on. What's up? Jeff Rains, North Carolina. If I have 50,000 long-term capital gains and dividends and 50,000 income from work, do I have to pay taxes on the dividends and capital gains if I am married? Okay. So my man, Chris Johnson, He asks, so we got 50,000 long-term capital gains and dividends. I'm going to presume those are qualified dividends, and 50,000 in earned income. And he's married, filing jointly. All right. So the first thing we got to figure out is remember the difference between AGI and taxable income. So if you're under the age of 65, in this case, you're going to have, basically your taxable income was 100 minus 24 is $76,000. All right. So in this case, $76,000, you're still in a 12% tax bracket. So the answer is most likely you're not going to pay anything on those long-term capital gains and dividends simply because you're still in the 12% bracket, if that makes sense. I did a video a long time. I'm literally at 800 videos. So literally, I haven't been here for a year yet. That's how addicted I am to this. My crack. It's like I need a pipe to smoke up YouTube videos because I love it so much. But anyway, so I need a. I did a video a while back, and I no way I'll remember where it is about that exact scenario, Chris. I'll do another one here pretty soon to show you, according to the right capital software that I use, that you'll see exactly what happens when it comes to that. Because there's a sheet, a tax form, and let's see if I have it when it comes to your qualified dividends and capital gains. And I got so much stuff over here in terms of stuff I want to. It's right here. All right, so actually, I need to go up. Oops. I hope you all can see this. This is the sheet, the qualified and dividends capital gain worksheet. Now, this is going back to 2017 rules, but basically what happens here, and I actually did the whole video when he filled the sheet out, and what happens is it doesn't flow until you're 1040, and that was line item back in the old days. I want to say, I'm drawing a blank. What it is now? Is it 15? We got 8, 9, 15. I think it's 15. Yeah, I can't remember, but it was 8, 9, 13, 15. I forgot. If my man Ken in Atlanta was here, he'd be telling me what it was. But anyway, there's a separate sheet that you fill out for qualified dividends, long-term capital gains. And what happens is it's actually pretty cool because you're saying you're looking at your 1040. And again, this isn't the new ones, this is the older ones, but you're saying, what happened to my income? Because it looks like my gross income, my AGI, and my taxable income is $50,000. But yet I have no taxes due. Why? And the answer is because this tax form right here, it basically says it doesn't flow over to your 1040. It's confusing. I'll do another video on it because it was absolutely awesome. Yellow Jackets, yes, sir. Ernesto, are you from did you go to Tech, my friend? That's where my daughter goes, Georgia Tech. In fact, you know who's in town, don't you guys? Who's at Atlanta right now, practicing on Bobby Dodd Field as we speak? Touchdown Tommy, everybody's favorite guy, right? Touchdown Tommy's down there. I can't tell you how many people give me negative comments on my 13 states that don't tax Social Security and don't tax pension, and how much they say, stop your stupid talking about the NFL, you fool. I just delete them all. I laugh. I said, man, really, that gets people pissed off. Okay. To receive the spousal benefit, does the spouse have to wait until you deem yourself? That's a good question. All right, so I always forget this, and this is where my man Devin Carroll, because he's a master when it comes to everything Social Security. All right, so if you wait till you're 70, can your spouse receive the spousal benefits before? If she's 66 and you're 68, the answer is no. You have to file for her to get the spousal benefit. So basically, myself and my wife, I'm 4 years old. Let's say I'm 2 years older than her. I'm 68. She's now 66, so she's at her full retirement age. She wants her spousal benefit based on my record because she's at her full retirement age. I got to file for my benefit, and I can't. I mean, if I file for my benefit at 68, I don't get advantage of the delayed earnings credits. So I got to wait till I'm 70, and then she will be 68 before she can get her spousal benefit. And it doesn't do her any good for those 2 years. That's what happens. So then it would have to be a matter of what does her own benefit look like at her full retirement age. So there is my man Fred, who loves the Pats, by the way, he's a big Pats fan versus the Rams. There is a big benefit of waiting for me to file, but obviously for delayed earnings credits. But there could be a big negative for my surviving spouse, my living spouse, Charlotte, in terms of she'd have to wait until I file before she could take her 100% spousal benefit. If that makes sense. Now for us, it's great because I'll be 70 and she'll be 66. And we're good to go because when I file for my delayed earnings credits, she'll get her full retirement age benefit. Actually won't, because she'll have to wait till she's 67. So it won't be quite as good. Anyway, hope that makes sense, Fred. Go Pats. Yep. Wellesley Income Fund, and I 100% agree. A wonderful fund. Look, I'm not saying, look, anything on here, I'm not advising any individual. When it comes down to it, the Wellesley Income Fund should be something you should look at, bar none. What ETFs do you like for taxable? For some reason, IXUS gets a 1 for tax efficiency on Lipper. Yeah, I'm not sure what the IXUS ETF is, my man Quincy. I like any ETFs that don't pay dividends for the most part. I don't know why the ETF would get a low tax efficient. I don't know why that happened. But the nice thing about ETFs versus mutual funds, I guess Vanguard has another reason like Vanguard. Their index funds have even a better way of tax efficiency on their mutual funds, their index funds, that I think some other companies don't. I don't know if the way Vanguard's structured as the ownership entity, as a mutual company that it is, I don't know. But ETFs, you don't pay tax on capital gains in ETFs. You just don't on a taxable account. It's basically reinvested in there without you having to get a 1099 distribution. Mutual funds, that's not the case. Mutual funds, you do get a 1099 distribution on a taxable account. So ETFs are always preferable. The mutual funds are taxable accounts unless there's a Vanguard fund of some sort. And I'm still not convinced on that, but I've read enough where I think some guy had told me about that. I think he's right. But ETFs are always preferable in a taxable account to a mutual fund. I mean, 98% of the time. Other ETFs are ones that don't pay dividends. I don't want any dividends if I can avoid it in a taxable account. Of the 3 buckets, I want my high-flying growth stocks in my taxable account because I don't want any distributions. Distributions are bad unless I need the income. But if I need the income, I want to come out from my IRA simply because I want to start paying down that debt, i.e. what I owe Uncle Sam in the future. And if I leave my beautiful wife a large IRA, it's going to kill her from a tax perspective. So I don't want any distributions, no income from my taxable accounts. I want nothing there. If I'm in the 12% tax bracket, that's a different story. But just for this scenario, I want nothing there. And my Roth, I want my REITs, my real estate investment trust. Anything that is high dividends, I want my Roth. So stocks in my Roth, aggressive stocks in my taxable account, bonds. If I'm going to own bonds, I want it, or CDs even, I want those in my IRA. Absolutely. So that's the way I look at it. Dividend paying stocks, real estate investment trust, I guess even high yield bonds. But again, high yield bonds don't give you growth. I still do high yield bonds in my IRA. But that's what I'm looking at my Roth, dividend stocks, real estate investment trust. Seems like I'm missing one other thing. I forgot what it was. And then corporate bonds and government bonds in my IRA, and then high growth, lack or very limited dividend paying stocks and ETFs in my taxable account. So remember, of the 3 buckets, and I don't have my wife and kids inherit bucket 3. That's my Roth, tax free. No mandatory distribution to my wife. There is mandatory distribution to my kids, but that's mandatory distributions are still tax free to them under current tax law. My wife and kids, community property state, California. My wife inherits taxable accounts tax-free. My kids inherit taxable accounts, all tax-free, community property or common law, even Louisiana, doesn't matter. IRA money, my wife inherits all that taxable with required distributions. My kids inherit all that taxable with required distributions as well. So the 3 buckets, the middle one, the IRA/401k, TSP, 403b is the least tax efficient there is by far. So I want to minimize this one and maximize those. Hope that makes sense. It's a big deal. And if you have a financial advisor, they're not talking about asset location or heaven forbid. Oh man, if your financial advisor has you're a 50-50 stock bond investor, and they say, okay, Mrs. Smith, we're going to put you 50-50. We'll just use Wellesley and Wellington Fund in your taxable, Wellesley and Wellington Fund in your traditional, Wellesley and Wellington Fund in your Roth. You need to jump off a building and slice up your wrists and go into a freaking water full of hungry sharks because you're just killing yourself. It doesn't make any sense why these people do it. And I see it all the time. You're 50-50, so we're going to have the same located kind of accounts in all 3 locations. It's horrific. It's horrible. Don't do that. You want your aggressive stuff here, your corporate bonds and government bonds here, and your high dividend paying stocks there. That's what you should do. And these advisors who are getting paid 1 1/4 or whatever the heck they're charging to tell you this nonsense is nuts. And yet, yeah. All right. Oh man, do I recommend Medigap or Medicare Advantage? Well, first and foremost, I'm not a licensed health insurance rep, which means I can say my opinion. I'm going to Medigap, David. Absolutely. Medigap/Medicare supplements. And the reason for that is very simple. Anyone who takes original Medicare, any docs that's out there, if they take original Medicare, they could be up in Anchorage or Fairbanks, Alaska. They could be down there in, Key West, Florida, or Caribou, Maine, down to San Diego. If they take Medicare, they have to take you under Medigap. That's just all there is to it. So your network is the entire country. Now, going overseas is a little bit different, but my man Buddy Sorrells put a thing from Michigan, put a thing on that web. He sent me an email on how to get insurance if you're traveling overseas. So look at my video on how to travel cheaply in retirement. There's a link in there into I think on a company who does, there was a company who does cheap insurance when you're traveling overseas, because Medicare, I don't know the whole rules for that. But anyway, so if I want to be if I'm going to be traveling, RVing, Medicare Advantage, in my opinion, is not beneficial, because Medicare Advantage is an HMO or PPO, but mostly an HMO. Each individual insurance company has a network of providers. So if you have Medicare Advantage in San Diego, you're probably okay. But the minute you go to Caribou, Maine, is Aetna, are they going to have providers covering in Caribou, Maine? I highly suspect they won't. And so that's a big deal. And so what are you actually getting into if you need someone to provide you health care services up there? I think the answer is going to be tough. Now, if you're in Miami, Florida, and there's tons of old people and they're all retired and enjoying the life on the golf course, there's probably tons of docs that provide all kinds of network services in that Aetna and Medicare Advantages. And that was going to be cheaper without question. Medicare Advantage is cheaper than Medigap. I 100% agree with that. Another drawback about Medicare Advantage is just going through all my stuff on trying to figure out the Obamacare stuff. And I got all these papers here. And when I was trying to figure it out, and literally I said, I'm done with it. I can't do this anymore. It makes my head hurt looking at all these different things. I go to Medicare.gov, and what they had on there was wrong. Then I go to the individual websites, and you got to log into each one. You got to sign up. And I was just like, this is nuts. I don't want to do this. I'm just going to MediShare, which is what I did. If nothing else, just because this is painful to me. It hurts me. And I like to read. I'm not against reading, but that was just painful. And I literally hated it. And so think about Medicare Advantage plans. They change each year, my friends. And we're talking not just the plan, the actual prescription drugs. You have drug A covered today and next year is not covered. And yet we're all going to default by, again, water and gravity. You take the path of least resistance. So now you're like, I've had this Medicare Advantage plan for all these number of years. It covered Lexapro just fine. And now I go in there and also they don't cover Lexapro. And they said, well, we sent you something, David. We sent you a piece of letter or mail that said we don't cover Lexapro anymore. Sucks to be you. And you're like, man, screw that. I'm going to go back to Medicare supplement, i.e. Medigap. And Medigap providers say, that's great. You're going to have to go through underwriting. You're like, wait a second. I thought I didn't have to go through underwriting if I went from Medicare Advantage MA plans to Medigap plan. They said, no, it doesn't work like that, kind sir. You're going to have to be underwritten. And if you have some pre-existing conditions, guess what? You're SOL. Now, if you live in some places like I think it's Connecticut, some of those northeastern, more liberal states, they have guaranteed issue on Medicare Advantage, not Medicare Advantage, Medigap plans. But those suckers, they ain't cheap. I'm telling you right now. My man J-O, J-A-E-O-H, J-O from Maximize Your Medicare. He literally wrote the book on Maximize Your Medicare. And he's up in Michigan, and he does a lot of talks on public radio, and he comes down to Atlanta, goes down to Florida. No one knows more about Medicare than that guy. So I can't remember his website, but just type in J-O, J-A-E-O-H, and that literally two names. J-O, he's Korean. He's American by birth. His dad was from Korea, and his mom too. So it's J space like Josh space Scandlen. But look him up on his website. He has a ton of information on Medicare. And get his book. He just republished the one for 2019, and sign up for his website, his newsletter too, because it's a plethora of information on that stuff. And I tell you, no one knows more about it than this guy. It's nuts. T Powell and T. I always think I want to call you Tina. I don't know why I have that in my head, but I just have T as Tina. And so if I ever say Tina by accident, that's just for some reason I got Tina in my brain for you. All right. Do spousal benefits go down at 67? So spousal benefits are only applied to when you take it as a spouse, if that makes sense. So it doesn't matter when your spouse. I'm trying to file for my spousal benefits. My spouse filed early. My spouse received a reduced benefit because he or she filed early. I'm the spouse. It's still based on my spouse's PIA. I hope that makes sense. There's a lot to chomp on that, and it took me forever to get that through the big old thick noggin of mine. Just remember, spousal benefits are based on when you as the spouse files, not based on when the other guy files, only based on you. So I hope that makes sense. What software are you using when you're it's called Right Capital, Editha. Right Capital is what it's called. I promise I'm going to make this available for a fee. I'm going to charge a fee on it, but I'll make it available soon here. I just like doing YouTube things, and I haven't got around to actually putting together yet. It'll be easy. You just send me some money, and I'll get you in the system, and it's all yours. And I'm not going to call you. I'm not going to reach out to you. I'm not going to solicit you. You do whatever you need to do on there, and it'll be there until either Right Capital goes bankrupt or I've refused to pay them anymore. But I like Right Capital. I love what they're doing. There's some clunky stuff, like they just updated their 2018 tax forms, and they haven't. If you go into 2026, it still looks like there's some stuff they got to fix. It's fine, but any software that has big new things that come down the pike on tax planning, and particularly when they're using the actual tax forms, and then in 2026, when the Trump tax bill sunsets and it reverts back to pre-Trump's tax bill, presumably. They got to put the old forms back on, and I'm sure that's not an easy task for them to do. But we did notice that. My man Ken in Atlanta noticed it, and I emailed Right Capital to update that. So it's not perfect, but it's good. I like it, and I'll get people access to that at some point. But for a fee, it won't be much, but it will be a fee. Quincy says, should Wellesley or Wellington be held in but taxable? I would not do that. No, sirree, Bobby. I'd put Wellesley in my IRA and Wellington in my Roth if I had to do both of those, and I had those two accounts. Absolutely. I have a pension, my man Les Torrey. If I have a pension and Social Security as a guaranteed income, do I need bonds in my portfolio? No, that's just my opinion. CB says, Quincy, yes, they can be a tax. They can be, but not from the tax efficiency. That's right. Exactly. Right on, CB, for chiming in there. Much obliged. Pension and Social Security are bonds. And I was talking to a guy the other day who said the exact same thing, maybe even on this live stream. Is awesome. Could not be happier to hear somebody say that. There's a guy named Moshe Milevsky, Moshe, and Mile, Moshe, or I don't know how you say it, the Jewish. I had a good friend of mine who's Jewish. He told me how to say it in the typical Hebrew way, but Moshe, Moshe, Miles, Milevsky. I can't remember how to spell it off the top of my head, but he's out of some school in Canada. And he writes, he had written a book, basically, You Are a Bond, and thus make your investments more aggressive. And I read that book 10, 15 years ago or something like that. I absolutely subscribe to the idea. You are a bond. Your Social Security is on you. It's a bond. Your pension is on you. It's a bond. So my personal opinion is, if you got Social Security and pension and that's enough to cover your expenditures, I don't see any reason to have bonds whatsoever. That's my opinion. Yours could be different, but you don't need bonds. So I'll just say it like that. Total International gets the one on Kenny Hart. Can you explain to me why it's good to get dividends on your mutual funds when they just drop the share price when they pay out? Okay, good. A great question, Kenny. My man Kenny bringing some wonderful observation. All right. So the question is, can you explain to me why it's good to get dividends on your mutual funds when they just drop the share price when they pay out? I've always been told this is free money, but I don't get it. The next time someone tells you it's free money, just say, hey, I'd love to see your 1099, my friend. Let's take a look at the 1099, because it's not free money. It's the opposite of free money. It costs you. And the reason it costs you is because you're going to get a 1099 in which you're going to have to pay tax on the dividend distribution. So what happens is financial planners that are worth any salt, and I used to thought this is par for the course for any financial advisory, but I don't think that's the case anymore. They always say, don't buy the dividend. So you have this X dividend date. We know we have a company, a stock that's $100 a share is getting ready to pay a $5 per share dividend. All right. So $100, they pay $5 out. The very next day, the stock is priced at 95. All right. Now for you, you're not mattering because you reinvested it. You still have $100 value. You got $5 of dividends, which went to buy more shares. So you have more shares at a lower price. That sounds like it's no big deal. It's like, hey, no big deal. But the problem is that $5 dividend distribution is taxable to you as a dividend income stream. And so it's the worst thing because A, it's definitely not free money. B, the share price drops, yes, but the reinvested dividends will make the share price, the total value go back up. And if you don't reinvest dividends, the share price drops and you got this cash over here on the side, which you can do other things with, but you're still paying tax on it. And so what would happen is you say, okay, I'm going to make this so we know on December 15th, company A is going to pay a dividend $5 a share. So I'm going to go in there and get the free money. I'm going to buy it on December 14th. You're like, okay. So what happens is now you bought it. Now you bought a $5 taxable distribution of which you still only have $100 of value in your account. Your account value hasn't changed, but you have to pay tax on that $5 dividend distribution. You bought the dividend. If you just would have waited a day, you would not have bought the dividend. You still have the price per share would be $95, absolutely. And you could have bought it then and not have to pay tax on the dividend. That's exactly how it works. So you're not any worse for the wearer or better for the wearer by waiting a day. You're not, but you're not paying tax on that money. So don't buy the dividend. In fact, it used to be that if you weren't telling people when they're getting ready to make a transaction in a brokerage account, a taxable brokerage account, a taxable account, you can get in trouble. I mean, literally, as a broker, as an advisor, say you didn't advise them on not buying the dividend. And if someone were to file a complaint with the FINRA, you would absolutely be held accountable. Say, I didn't know I was buying the dividend, the client would say, and you're like, ooh, yikes, I should have told them. So you had to document like a freaking crazy man that you told them, I told Mrs. Jones, if she makes that purchase today, she's buying the dividend. And you had to document that, or else because you could be held up accountable for not informing her of not to buy the dividend. It's confusing as all get out. I get it, but I'm just telling you right now, there's no such thing as free money when it comes to this stuff. None at all. It's the exact opposite of buying the dividend. Is you're buying a taxable event. If you just would have waited the next day until the dividend was paid, you would not be buying the taxable event. It just is that simple. I hope that helps, Lee. Or Kenny. That's a great question, though. All right, Chris. If rates falls, bonds certainly grow, assuming you sell before it matures. Oh man, brother. All right. So then, what do you do with the proceeds? All right, so all the time, seesaw. So basically what happens is if rates fall, all right, so now I have a 5% bond that I bought at 100. Now rates are down to 4%, all right? So what happens? I got 5% bond that I bought at 100. Now I got new bonds that are still at 100 that are being issued at 100, but now they're only 4%. Inherently, my 5% bond is much more valuable, so I'll sell it for a capital gain, which is true. I do sell it for a capital gain, but what do I do with the proceeds? All right, so I sell it for 105. Well, I still got to go out there and buy a bond, but now the bond that I'm getting is only paying 4. So it's net wash. It's on top of the fact that you still got to pay tax and all that. So you're not making money on bonds. It's just not happening. You're going to make interest. If you're going to sell it before it matures, that's fine. It's literally it's a capital gain in terms of the eye of the tax man, but you still got to do something with the proceeds. And if you can go back to the bond market, I'm just telling you, it's the seesaw. You'll not escape the seesaw. No way around that. Also, annuity, it doesn't make any money. Wellesley, average return. Yep, can't beat that. Kenny, see Josh video in the review. Okay, add 2% can add 2% over time. Thumbs up, Josh, for lots of great info. Thanks, Bruce. My man Bruce up there in New York. Yes, sir. one of the many good Leos out there, law enforcement officers. I do think in some of the Facebook pages I trowel, because I am a libertarian-minded guy, generally speaking. Some are very not very respectful of our Leos. I know there's always scumbags in every level of the business, but I think the vast majority of Leos are good people. And so my man Bruce is one of them, and kudos to you, sir. Apple love it. Have positions in play from before the iPhone 1. Yeah, Winty, I had a lady from Knoxville, Tennessee. I'll never forget her. Was it her? Anyway, maybe it wasn't her. I think it was. She bought Apple in '97, I think when Steve Jobs just came back or something. I can't remember. She didn't know anything. She just said, I just liked him. I like the fact he's coming back. I bought Apple. This is after Steve Jobs went hat in hand to Bill Gates asking for some money. And she bought it for $7 a share. I think she only bought 100 shares or so. I can't remember what it was, but she had like $400,000 in her account. This is like 8 years ago too now. I mean, Growth Fund America, my IRA. I'm a huge fan of Growth Fund America. I love, I love American funds. No one's going to convince me about American funds. Hard to go wrong with American funds and Vanguard. I used to say this all the time. I say Vanguard for bonds, American funds for stocks. Man, you're going to have a you're going to have a hard time beating that portfolio. Debt free is the way to go, says my friend Ellen B. Retired and happy almost 4 years ago. Yep. No relations to Fernand. Whoa. I was at the 1977 World Championship game against the Yankees. Man, that's nuts. Not related to Richie Valens. Okay, I did not know Richie Valens was a Valenzuela. That's interesting. Man, you're at that game. I hope you still got your ticket stub. That's when Reggie Jackson was tearing up the Dodgers. Oh, it brought tears to my eyes. A huge Dodgers fan. And Red Sox for the AL, American League, Red Sox, and National League was the Dodgers. 4%. Okay. Steve, Texas, my man Steve in Texas. That's a big issue I have. Paying 1% to manage my assets is just crazy. If all they do is put me to fund and change it rarely. Though I do have trust issues. You do need a fixed income exposure in retirement because you don't want to sell your equities. 1 second. I just saw my man, somebody say, okay. Dave says, don't raise your, he's offering it. Okay. Man, what happened here? Okay, 90%. Okay. I saw your thing. You need someone you want. What happened? It went way down here. Okay, here. And I was the one that shows me a dollar value by year. Okay. So late again in Garland, Monty. Late again in Garland, Texas. Robo investing like Betterment. Yeah, I got no problem with Betterment. Betterment works fine for me. I'm not the biggest fan of the was a Wealthfront. My man Med Faber took him to task for some things they were doing that was I just thought was not. I mean, look, I'm not. Well, I just didn't like it. They were doing some stuff I thought was not good, and it wasn't good. Let's just put it that way. So of the two, Wealthfront, Betterment, I'd go with Betterment. But I mean, be honest with you, if you can get Vanguard at 35 basis points with all that Vanguard has to offer, I'd go with Vanguard without question. I love the Schwab Intelligent portfolios as well. I mean, I'm a fan. No other way around that. Go Ravens. Oh, for the love of me, man. My man Fred says go Ravens. I can't stand Ravens. Ugh. All right. Would love a good video on what order you would use to save. Like what order would you save into which type of account and what you fill up to take advantage of tax advantage options. Well, I'll touch on that for just a second. I think you should take advantage of the 401k to the extent of the match. And then I think you're done. I really do. I am not. I mean, traditional IRAs and 401k plans. I do not think they're cut up to be. I'm not like this real estate guy who says 401ks are scams. What the hell's that? That's just weird to me. Why are they scams? I don't get that. But I think 401ks are a tax bomb waiting, which is exactly what some crazy guy wrote a book called The Tax Bomb in Your Retirement Accounts. Oh, I just happen to have it here. The Tax Bomb in Your Retirement Accounts by Josh Scandlen, because the tax ramifications of deferred accounts are insane. So I would take advantage of the 401k up to the extent of the match, and then I'd do the Roth, absolutely, without question. And then I would do the Roth IRA, and then taxable accounts. I mean, max out your Roth to the extent that you can cash flow. Roth IRAs, maybe even before you do the Roth 401k, because the nice thing about a Roth IRA is it's liquid. I mean, you have access to your principal at any time for any reason, regardless of your age. That is a fact. Not on the Roth 401k so much, because the Roth 401k, you still got to go through your employer, but a Roth IRA, you do. You don't have to be 59 and a half. You don't have to wait 5 years. The Roth principal that you put in that puppy is yours for the taking at any time. So take advantage of the Roth or the traditional 401k to the extent that they have a match, and then go to the Roth IRA. And then if you have money left over, do the Roth 401k too. That's absolutely the way I do it. Let's see. For the Vanguard 500 is too expensive. $200 per share. No. Don't worry about the share price. I'm telling you, Berkshire Hathaway, the Class A shares, they got all kinds of rigmarole saying you're charging too much. And he's like, man, I mean, it's a little bit different. That's like $130,000. But at the end of the day, $200 per share at 10 shares is the exact same thing as $20 per share at 100 shares. I mean, it's the same. It doesn't matter. It's the same thing. The old broker me, I like round lots, 100 shares. I like 100 share units. That's my preference is that, just because that's the way I was trained. Round lots where you can sell covered calls against that. You can't sell covered calls against uneven lots or odd lots is what it's called. But it does, if I had one share at $200 or 200 shares at $1, it's the same thing for the index fund, not for an individual stock. Use the Vanguard 500. Yeah, I agree with that because of low turn. Yeah, 100%. So my man Sailor High Performance says use the Vanguard 500 for your taxable account because that's low turnover rate. Yep. I actually did a blog post on that too, on not just turnover rates, but how also mutual funds are expensive as well. And I'll repost that when I find it. I got so much stuff on the website at heritagewealthplanning.com that I say some guy wears a bow tie. It's like me, but I think he's talking about somebody else. But anyway, I did a blog post on that. The basically you're looking at the turnover rate in of itself is not just the fund expenses. There's more to it than that, and it's significant too. And of course, the SEC doesn't regulate that, so they can charge pretty much whatever they want because the SEC is like, well, I don't know. Well, what are you there for, Securities Exchange Commission? If you're not regulating these people and they're charging us these fees, what is it you're doing? Oh, we're there to make sure that what exactly? See, someone you once mentioned who does the YouTube videos that you said you enjoyed recommending I don't know anything about peer-to-peer lending, Steve. I just don't know. Wears a bow tie. Yeah, I forgot that guy's name. He did a video on dividend stocks, and I think he was not inclined for AT&T, the bow tie guy, kind of balding guy with a bow tie. And again, if you wear a bow tie, you must be smart. At what age can I start taking money from my IRA without penalty? 59 and a half. If it's a Roth, it's different, but if it's a traditional IRA, it's 59 and a half, Clint, without penalty. Never borrow money, Clint. 50. Yeah, there you go. 9%. See, peer-to-peer lending is lending people cannot. Okay, I will need some help. I'm sure about the best way to pull out of my traditional TSP when it comes to retiring. Yeah, I'm a fan of TSPs, man. No other way around that. I just am not a fan. Everyone keeps, I got lots of people stoked about the new Modernization Act of 2017, and I'm telling you, it's better, but it's not better for spouses. It's not. The beneficiary participant account, Quincy, is horrific. I just know getting around that. And so they didn't modernize anything for your spouse, and they didn't modernize anything for an heir. And the whole thing about the TSP for me has always been the beneficiaries. I mean, it's more liberal now for you to access your own money. A lot more liberal is great. But if you're married, it's horrific. And so if you're not married, I believe in the TSP, frankly. If you are married, you got to get that sucker out because your surviving spouse is going to be in a world of hurt. And if she inherits that and then she leaves it to her heirs, i.e. your children, they have to take a flipping lump. What is it? If she receives if the BPA, the beneficiary participant account, receives your money, guess what it is? So what happens is you die, you leave your TSP to your spouse. What happens, TSP will open up a BPA, a beneficiary participant account. Now, what happens is at her death, her kids have to take, your kids have to, or anybody, it doesn't matter, have to take a lump sum distribution on that amount. It's nuts. It's absolutely nuts. It's devastating. It's travesty, and it ticks me off. But they did liberalize it for you. Yep, they did, but not for your heirs. Thought you couldn't get spousal benefits after. Ooh, no. You can absolutely get spousal benefits. You can't take a restricted application, kicking the can down the road. You can absolutely get spousal benefits without question. Is after 1954, if you're born after January 1st, 1954, you can't file a restricted application, which I don't really want to get into all that much right now because that will make my head spin because that's tough. If you're born January 1st, 1954, and you're married, you can file a restricted application, which is a way you can kind of get double up on your benefits. To January 1954, you can't do restricted application, but you can still take spousal benefits. Absolutely. I usually can't trust most YouTube financial planning people offering advice. Let's say, Josh, you seem more logical and honest than others. That's because you don't know me, Steve. My man Dustin Tibbetts over at Jazz Wealth. Yeah, Dustin, I'm going to go down there one of these days. Maybe I'll go down like when it's flipping cold here like it is now. We're going to team up and do a video in his little place he's got there. I've been meaning to do that. Dustin has influenced me greatly on this right here. I tell you, I'm a huge fan of Dustin and what he's doing down there. I love the guy. I think he's at some point he's going to offer a trading class on trading. I think even options, if I'm not mistaken. And I don't want to do it. I did that when I was at Schwab. I got killed. I'm never getting into it again. But for you all who are interested in trading, watch my man Jazz, Dustin Tibbetts over Jazz Wealth. I don't get not against reading the dude. I'm not sure what that means. So if you want to elaborate, Dave Ramsey, what can you say about old Dave? I think on getting out of debt, he's good. I think he's absolutely atrocious. His claim that reverse mortgages are scams, that's not the case. Absolutely not the case. And unfortunately, I think a lot of people have listened to Dave, the types of people, many of which might be on my own YouTube channel, believers, probably just regular working folks, maybe not blue collar so much, but certainly not, Mr. Burns style, high flying, falutin people. And they listen to Dave Ramsey saying reverse mortgages are a scam. And now they don't know where to turn because it looks like they're afraid to run out of money. So they stay in their crappy old job, which it literally kills them when they have all this equity in their home that they could tap into for a source of income that's tax-free, which doesn't increase your provisional income. It doesn't increase your Medicare premiums. It doesn't increase your capital gain in qualified dividends. I just find that to be sickening that Dave would say something that's so blatant as blatantly wrong as saying reverse mortgages are scams. And he'll use this example of some guy in the Washington Post he read that some lady got put out of her house. And he says he attributes it to freaking reverse mortgage. No, she got put out of her house because she didn't pay her property tax. It had nothing to do with reverse mortgage. I don't care if you have no debt on your home whatsoever. You don't pay your property tax, the county's going to come put you out. There's nothing to do with the product. Had to do with her not paying her property tax. I mean, what? It's nuts. And I was sitting there. And then Dave, all right, hey, real quick, if you would, my man Miles Beckler did this when he was doing it. And if you into YouTube videos and how to maximize YouTube content, Miles Beckler, go to milesbeckler.com. The dude is just awesome. Love the guy. Another one of my mentors. He doesn't know me, but I followed everything he's done. Give a thumbs up. Anyway, I was watching his live stream on Saturday. He said, stop and give a thumbs up. So if you don't mind, if you're still on here, if you haven't thumbs up, give one. The reason is it helps the YouTube algorithm say, hey, this guy has people who like his stuff. And they put this on more people's videos. So it makes me look better to YouTube. It gets more subscribers, which helps me more people to watch the ads that I put on there. By the way, Tom Steyer, I can't stand the guy. I do not like hypocrites, and Tom Steyer and all these rich greenies who are flying all over the world are hypocrites. And if he's throwing ads at impeaching Trump, look, I'll take his money. I don't care if you don't like Trump. He's not getting impeached, so stop it. Tom Steyer, if he wants to waste his money on that, his billions of ill-gotten gains. I don't support it. I don't recommend it. But if he wants to pay on this thing to do that silliness, I'm not going to tell him not to. I'll be happy to take his money and preach against him because I can't. Can't be green and fly. It's just, you can't have it. You can't have it both. And I know that ticks some people off, but the facts are you can't. You cannot get on an airplane and fly to where they go to Davos and say you're so big of a greenie, not flying to Davos on a private jet. No, you aren't green. Yeah, man, if we only could get the hippies of the old days where they're compost and they're easy living and let people live the way they want, I would kill for have that back. But I guess those days are gone. All right. Dave Ramsey, another thing I do want to say too, someone said, hey, I got $1 million. How much can I possibly take out from my portfolio? And he said he was advocating $70,000 a year or 7% a year because the markets give you 10% a year. And it's nuts. That's nuts. That's horrible advice. And obviously Dave Ramsey doesn't know me. I'm a flea to him. But I even on that video, I typed in the real life scenario of how that would happen, how this person would run out of money. If they started doing that in 2000, they would have ran out of money. And I showed you exactly just using, I think I used the S&P 500 camera, but I did it year by year by year. That if someone's watching that and they're listening to Dave Ramsey's advice and be able to take 7% a year from their portfolio and that they're only adding to their principal, that's just doomsday stuff there. All right. Look like a nice piece of software. Okay, right on, Steve, about my Right Capital. Right Capital software is excellent. And Jeff, okay. Because Jeff, I clicked on your link the other day because I'm a little bit late in falling back to you, and there's nothing there on the software. So I didn't know if that meant you were upset with me that I didn't click on it quickly enough or that you took it down. But okay, well, if Jeff Rains, whose software runs Right Software for a living, been doing for a long time, says Right Capital is good, that makes me feel pretty good, and it's not perfect. Quincy don't have bonds because he's a federal pension and Social Security. Yep. Monty says Pats 31, Rams 20. Nope, it's going to be 27-23 Rams. You heard it here first, because anyone who's born and raised in northern New England knows you always think your team's going to lose. You have to think that way unless you're a newcomer to the sports, Boston sports. Oh, man, someone gave me $10. Much obliged there. I appreciate that. Thank you, sir. You did not have to do that, but I appreciate the what's it called? The Google Super Chat, the Super Chat. Thank you. I think that's Steve in Texas. CB Quincy, convert all TSP before taking Social Security is the right answer for most. Make an appointment with Josh for an hour, well worth his fee. Well, I appreciate that, CB. See, Steve Quincy, I agree. If you have other sources of income, I tend to shy away from bonds. Yep. Cindy B. All right. I remember you've been around before, Cindy. Welcome. I haven't seen you on the comments lately, so I appreciate you being back. So interesting. I must have a big snot hanging from my nose or something. Yeah, Monty, I don't disagree with that. My man Monty in Texas, North Texas, says when you get older, bonds are good. I don't have any issue with that. None whatsoever. I mean, just look at Wellesley Fund. It's a great fund. It's heavy in bonds. I'm not going to disparage that. Not in the least. It really depends on what you're trying to accomplish. If you're trying to reduce your risk on a volatility perspective, I mean, Wellesley is a perfect example of what bonds can do for you. I mean, Wellesley, the worst year it ever had was 9.84 in 2008. And that sucker has been around since 1971. So 73 and 74, nothing. 87, nothing. 2001 and 2, base. And when I say nothing, I'm talking like 3% down. And then 2008, it was down 9.84. I mean, it speaks for itself. So if reducing volatility in the fluctuating share prices of the stock market is scary to you, I'm not going to argue with bonds whatsoever. If leaving a legacy to your heirs is important, I want stocks. Or if leaving a legacy to your heirs is important, I want life insurance. That's for sure. One of those two things. Bonds aren't going to leave a legacy. It's just not going to happen. Stocks and life insurance are going to leave a legacy for sure. In terms of growth, I'm saying. If for an income perspective, I'd much rather have you do income annuities, frankly, and stocks on top of that. So income annuities for income and stocks as well to get you the growth as that goes forward. I've done videos on that. I'll do some more on that again because I'm getting a larger YouTube channel, and I got 800 videos. There's no way everybody's watched all those, but I'll do another video on that where we're using the 2-bucket retirement plan. And this time I'll throw an income annuity in there to show you how they work in terms of literally how it can maximize your portfolio without question and your staying power to make sure that you don't run out of money. Dividend stocks have average returns. You want companies that reinvest their capital. Okay. Matt Nicholas. All right. My employer provides 457 plan. Should I invest in large cap or bonds if I'm withdrawing for the first 15 years of my retirement from the forfeit due? I'll be younger than 60. Should I invest in large cap? That's a pretty big divergence there, my man, Matt. Large cap or bonds if I'm withdrawing for the first, I don't know. I don't know. I'd be hesitant to make any suggestion there. Sorry, brother. Steve, Texas, where do you suggest you put your emergency fund? I'm a fan of ladder CDs, Steve. I think ladder CDs are actually a way to go. And so I would say a year of cash, a 1 year CD, and a 2 year CD. So you got 3 years covered. All right. So you got 1 year sitting in a money market. Someone just told me today Vanguard's money market is paying 2.5. I looked, I said, no way. And for sure, I thought that guy was lying. And I looked it up, and sure enough, it's 2.5 for the Vanguard money market, VMMXX. Couldn't believe it. So what I would do is I'd put, a year in that. Now, it's not FDIC insured, and they do have this thing called break the buck rule now, where you can actually lose money in the money market. That's from a few years back. Hard to imagine that happening, but it could. It could. But I'd put a year in a money market, a 1 year laddered CD, and a 2 year. And when I say laddered CD, it means just you have a couple of CDs that mature in different years. And then I have 3 years right there. I'm done. Everything else goes to stocks. That's my preference, but for sure. I don't think emergency fund should be tampered with much. Now, my man Corey and I will argue to this till we're blue in the face, and it's a friendly argument. If you're young and you can't do both an emergency fund or a Roth IRA, I would say put your Roth IRA and make that your emergency fund and be 100% aggressive in stocks without question, recognizing you could lose 50% in a year's time. Absolutely. If they're mutually exclusive options, that means they both can't exist consecutively. I would absolutely say if I'm 25 years old and I need an emergency fund, because Susie Orman says that, but old Josh is telling me I need a Roth, kick Susie Orman to the curb and put the Roth as your emergency fund because you can have access to the principal at any time for any reason whatsoever. The markets fall, that sucks. It does. But hopefully it'll come back, and that's a big risk. But I mean, I'm telling you, man, the money you squirrel away in the markets today, it's going to be worth its weight in gold. Potentially. We don't know. I mean, we might have communists coming over to take over the country, and then there's no more capitalism, and then we're all doomed. The great leap forward like Mao did in China. We don't know. I mean, that could happen for sure. Hopefully it doesn't, because we have a pretty heavily armed society here in the United States. Hard to imagine a Mao Zedong taking over and telling us here in Fulton County, Georgia, that we got to move to dig ditches in Dahlonega or something like that. But I mean, again, we don't know what the future holds, but I would take the risk. And if I'm young, put my emergency fund in the Roth if those two things are mutually exclusive. For my man, Steve, Texas, I don't think he's that young. I think having 3 years of cash, which is savings, and 2 CDs, man, and let the other stuff just let it run its course. Hey, Josh, love your channel. Hey, get a good lunch on me. Thanks, Steve. Might have to take my beautiful wife to get some. We love our Mexican. The one thing about living in San Antonio, oh man, I do miss. They had Papacitos. They have a Papacitos up here. It's actually owned by Greeks. They own Papa Do's, but they had a place, Mamacitas, down there on 10, and they had a fiddler playing. Oh, Mamacitas was awesome. So I'm a big fan of Texas Mexican food, Tex-Mex in particularly, and my wife and I love it. So we'll take your $10, Steve, and we'll go buy at least a Qdoba burrito. Not quite the same. And here in North Georgia, North Fulton County, they got this Mexican food restaurant called Cinco's, which actually is pretty good. So if any of y'all are ever in this neck of the woods up in Cumming, in the Vickery Plaza, they got this place called Cinco's, and I'm a big fan. So go to Cinco's and eat up your Mexican food. It's good. Let's see. I still enjoy your no BS. I love your channel. I'm most solely invest in real estate. Yep, man, I got no problem with that. Says my man. But I still enjoy your no BS traditional mindset. Thank you. I'm doing 2.35 through Ally through my reserves. Yeah, I got no problem with that, Quincy. That I'm doing a 2% no penalty CD at Marcus. Not keep. Yeah, I get it. Not keep inflation, but at the end of the day, cash is king. Remember, Warren Buffett, when everybody else was drowning, Goldman Sachs, because they weren't getting enough of our taxpayer dollars. Who did they turn to? Warren Buffett. Warren Buffett. He made out like a bandit, but he only made out like a bandit because he had cash. So all that cash, which was being wasted because it could have been in the market, as everyone I'm sure was telling old Warren. I mean, I'm sure they weren't telling him, but you know what I'm saying. Yeah, he made out like a king because he had the cash, and he took Goldman Sachs to the cleaner, as rightly he should have done, because he's representing his shareholders. And at Goldman Sachs, man, that was a lesson for me right there. When all hell broke out, there was one man standing. His name was Warren. And Goldman Sachs, of all people, freaking Goldman Sachs, can't stand those guys. Very good. Okay, Personal Capital. Yeah, I'm a big fan of Personal Capital. If you go on Personal Capital through my website, I'll provide the link at some point tomorrow. I get paid a commission. Frankly, can't remember how much the commission is anymore. I think it's $20 actually if you go on there and link an account. So if you want to take care of old Josh and you want to go to Personal Capital, their retirement stuff is great. Their tax stuff is horrible because they don't have anything. But I like the retirement planning quite a bit, actually. I thought it was quite favorable. Their tax planning was non-existent. But anyway, I think Personal Capital. If you go on there, I get $20 and you get $20 is my understanding. I got to revisit that. But if you're looking at designing some retirement planning for free and you link one of your accounts, Personal Capital, at least it was $20 for both of us. So if you want to do that, I'll take your $20 from Personal Capital and they'll pay you $20. I think the problem is they're going to have some guy calling you. So just don't pick up the phone. $50K to invest in a taxable account, says my man Deke. I'm thinking Vanguard ETFs. Should I lump sum it or do it as a, do I think the stock market as a value is overvalued? No, I absolutely do not. I would do a lump sum. And the reason for that, my man Deke, is a couple things. If you're doing ETFs, first and foremost, you're buying a share, a stock. That means every time you make a transaction, it is going to be a commission to you. Now, I don't know if Vanguard does commission-free ETF. I just don't know. But at the end of the day, every time you make a purchase, it'll be a cost to you to some degree. And secondly, if this is a long run, you will never remember what you bought it for today. You just won't. Thirdly, it's like you're betting against the house. All right. So if you're betting against the house, or you are the house, I should say. So the house knows every time you do that roulette wheel, was it 52% of the time they're going to win, 48% of the time they're going to lose, or something like that. And the market is like that too. Basically 55% of each and every year, individual single year, going back to the dawn of the market, essentially the modern era of 1926, the market has been up. 45% of the time or something like that, the market has been down. So you are the house. So the majority of the time the market's up on any given year, and the not majority of the time the market is down. So the odds historically are in your favor. So I just be done with it. It's just stay done and done, and you're good to go, my man. Can Roth 401k be withdrawn without penalty if I retire then? Can a Roth 401k, Dean Kruger, man, you're going to stump me there. I can't remember if a Roth 401k, anyone? I don't know. I think you still have to be 59 and a half. I don't know off the top of my head. Maybe someone else can comment. I just can't remember, to be perfectly honest with you. So the question is 401k Roth, but he's not. Yes, you can. Yes, you can, because a 401k, as long as you're at the age of 55 or beyond in a 401k and you leave it with your employer and not roll it to an IRA, you can withdraw that penalty free. So the answer to your question is yes. And in fact, if you're in a first responder, it's 50 years old, by the way. So if you have a TSP or your local county retirement plan and you're 50 as a first responder, you have access to that money, not tax-free, but penalty-free. So the answer to the question, as long as you separated by service at 55 or beyond, all right? You can't be separated by service at 53, leave it in your 401k, then come back and collect it after 55. It doesn't work like that. So let's say you're 55 years old now, you're quitting your crappy old job. Can you have access to your Roth 401k without penalty? The answer is 100% unequivocally yes. That's the benefit of the exception rules of the IRC code, the Internal Revenue Code. So the answer to that is yes. I'm already maxed out my Roth TSP. Yeah, right, man. Deke, you're going to be you're kicking butt. Let's Talk Money. That's it. Yep, bow tie guy. Let's Talk Money with Joe Hogue or something like that. I thought I heard Vanguard weren't ETF as efficient as the other like iShares? I don't know why that'd be true, Quincy. If there's, I mean, we're talking bottom of the barrel in terms of non-tax efficiency. If they're a little bit less tax efficient than iShares, it ain't much. We're talking, it's not enough to worry about. It's almost like this whole Charles Schwab charges 1 basis points. Vanguard charges 4. Oh my goodness, Schwab is cheaper. At this stage, the damage has been done. The good damage. It was 1.5. Then it was like 1. Then it was 0.85. And blah 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 in terms of mutual fund expenses. So the fact that Schwab is charging 1 basis point and Vanguard is charging 4 at that stage, it's a freaking crapshoot to me. Yeah, there you go, CB. Right on, man. You suggested we become a financial planner if we're interested. Can a person that isn't a CFP give an investment strategy? Yeah, absolutely. I mean, without question. Now, Steve Shea, the industry is very, what's the word I'm looking for? And this is one of the reasons why I dropped the Financial Planning Association, my membership there. And at some point, I might drop my CFP because they're pushing hard that no one literally can call themselves a financial advisor unless they have CFP letters. I find that to be an absolute affront to my freedom as a human being because I can call myself whatever the hell I want to call myself. Now, you buyer beware. You could say, Josh, you call yourself a Dikembe Mutombo center in the NBA. You don't look like Dikembe Mutombo center in the NBA, so I'm not going to hire you. But it's an affront to my freedom. It's a barrier to entry for other people trying to get in the business. And it's a way for them to raise more money off their captive audience of the CFP community. It's completely obvious what they're doing. It's completely obvious what the other CFPs are advocating for. They want to keep rabble rousers out. I know that. I can see that a mile away. And the thing that ticks me off is all these same CFPs are saying we need more diversity in the industry. Well, you're not going to get more diversity by increasing barriers to entry. The hypocrisy infuriates me. I thought I heard a noise. Thought my wife was looking at me, and she's not. And because, well, let me tell you, when my wife gives me that look, you know what I'm talking about. Woo-hoo, you get scared. She's not. But anyway, so I'm sitting there thinking, isn't that interesting? The FPA, Financial Planning Association, the Certified Financial Planning Board of Standards, and all the various CFPs out there, many just graduated college, never worked a real job. They don't know what the hell's going on in the world. They're just some dude. They got a degree in accounting, or they got a degree in economics, or heaven forbid, philosophy. Well, what am I going to do in my life? I'm going to become a financial planner. I'm going to go take a CFP. So I study for my CFP. I'm credentialed. Now I can offer financial planning advice because I have a CFP. But old Steve Shea, you don't have a CFP, so you can't offer financial planning advice. Or else what? It's against the law? It's nuts. So the answer to your question is, do you have to get registered? Yeah, absolutely. You can give advice without question. Without question. If someone wants to pay you for your advice, absolutely. Without question. Do you need to be a CFP? No, absolutely not. The CFP doesn't mean anything. All it says is you took a course study. The way people are passing it now, they're giving out CFP like chiclets, man. It's nuts. People are passing that it's a good course. Everyone should take it. But just because someone says they're a CFP doesn't mean crap. It doesn't mean crap in terms of their ability to give you financial planning. The road is littered with failed CFPs who are so damn smart, but they don't know how to talk to people, or even worse, they have no empathy for what you're going through as an individual, because all they did is they went to school, they got a philosophy degree, and now they're like, I don't know what to do, so I'm going to go to law school or I'm going to become a CFP. That's it. They get no experience. Don't get me started. And I hope you do it, my man. Shay, whatever, I missed you here. Oops. Anyway, I missed you. I lost some of the notes here. Money Guy Show. Hold on just a second. I lost my man Shay. All right. Well, yeah. So here's Steve again in Texas. I was looking around for a good advisor, but the only one. They want to manage my assets. I just want to coach. I would pay for teaching sessions, learning by reading it. No, that's a huge drawback. Huge drawback, Steve. A lot of advisors, they don't want to do anything other than manage money, and yet they're calling themselves financial advisors. And that's I find that is going to be the doom of our industry, frankly, because there aren't that many people who have assets to manage. And there are not that many people who have assets to manage that want them managed for a ridiculous fee of 1%. And I just, it's a pet peeve of mine. Let's see. What do you think about it? I got no problem with TD Ameritrade. None at all. None. Daryl, I got no problem with TD Ameritrade. Absolutely. Corey MG. Oh yeah. Let's see. I thought I saw you and Marty up here. I didn't, but I missed you somehow. My book should be arriving tomorrow. Thanks for buying it, Barry. Right on. There's a white nationalist growing around the moon. I don't know what that has to do with anything. Did someone say anything about that? Let's see. Okay, so here's Marty. Don't I have until April 15th to do a Roth? No, you had to do it by year end, Marty. Other guys have been what? Money Guy Show. We're in Texas. Steve, Dean Kruger, Dave Ramsey got me debt. He's great for that. Listen to Josh for investing. Right, hey, appreciate that, Dean. I updated software, says Jeff. Therefore, the old link isn't valid anymore. One of these days, I'll probably head down 85. Man, right, man. Love to have you down here, Jeff. Absolutely. The problem with annuity, it doesn't adjust for inflation. Then your buying power is down. Aditha, that is true. When I ran numbers on immediate annuities, I'm telling you, the front end versus where it's just flat, not inflation adjustment versus the one that have an inflation adjustments, it's so much lower on the ones that adjust for inflation for many, 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 many years that you have to live until you're like 88 to even break even there. Now, once you're 89 and 90, it's very valuable for sure. But I'm telling you, I never did one with an inflation rider. I just never did. And the reason for that is because, I mean, you are talking way down here to start with the inflation rider. And it just took forever to get up to where the income that you would have made from 70 to 88 or whatever it was. I think it's like 65 too. So you just got to look at the various options out there for sure. Your book should be me, Texas, Terrace. Don't know where that is. Susie Orman is not clear. My referral for personal capital is $50. Wow. My referral, if you're making $50 on personal capital, that's pretty good, Corey. First response, penalty free. Exactly, man. That's the new thing they passed. I don't know if that's a Trump tax bill or not, but that's a new thing they passed for sure. MG Crocker, I believe the time frame of IRA, yep, December 31st. That's right. I was looking around and we talked about that. All right. You like yeah, people keep asking about M1. I don't even know what that is. I guess it's a brokerage firm of some sort, M1. I'm just not familiar with it, Quincy. One of these days I got to be it. This is probably the 10th time I've heard people mention M1, and I'm thinking M1 Abrams. But I guess there's some kind of brokerage firm that does that investing software to some degree. So I don't know anything about it. Seemed like I came across one the other day that I liked a little bit. I forgot what it was. I can't remember. Fraction, and there's nothing wrong with fractional shares. I mean, nothing wrong with that at all. It wasn't any of those. M1, Stash, or Robinhood. Yeah, I can't remember. All right, guys, that's an hour and a half. I think I've hit my wall here. I tell you, you guys are fantastic. Much obliged for y'all being on here. It's I hope I didn't miss any questions. I probably missed a couple, and I apologize if I missed your question. If you want to put the notes down here, I'll get to it tomorrow. I promise you for sure. I do a lot of it. I love it. I love doing it. Steve, thanks for your $10, my friend. It's good stuff. My man Fred, the Patriots fan, says, I've heard that you can use M1 as a free robo-advisor. That's interesting. Don't forget, you can use Schwab Intelligent Portfolio as a free advisor too. They do keep 7% in cash, and everyone always has a bugaboo about that. There's a guy out there called the 712 Portfolio, a guy named Craig Israelson. I'm going to do videos on that because his stuff is awesome. And this is one of those things where I get the pushback on the Schwab Intelligent Portfolio with all the cash. What Craig Israelson shows, he shows that cash is an asset class. It's fantastic. So the Craig Israelson 712 Portfolio, where's the 12-7? 712. I'll show you some of the stuff that he does. It's fantastic. And you can get the spreadsheets. All you guys want my spreadsheets. I'm going to show you the Craig Israelson stuff. Get his spreadsheets, man. And it's I'm telling you, it's great. And I'll probably maybe I'll do that something tomorrow just to show you all because it's wonderful. All right. I am out of here. Thanks, guys. God bless. And we'll see you all next time. Thank you now. I appreciate you all being here for sure. And I got to stop this thing. We're going to hit that guy. Whew.